Good afternoon, everyone. I, CA Nidhi Bang, the moderator of this webinar, delighted to welcome you all to this webinar, which is being organized by the Continuing Professional Education Committee of ICI. And we are pleased to announce that we will be organizing this webinar series every Friday. So please block your calendar on every Friday to get insights into various emerging and high value technical topics. It is my pleasure to be a moderator for the webinar on Understanding Nuances of Industry Standards Note on Related Party Transactions under SEBI LODR and Asset-Related Ind AS Practical Issues. In a short while, we will start this webinar. First, I would like to apprise you about the CP committee. The profession of chartered accountancy is growing leaps and bounds, and its phenomenal growth has brought the profession to the forefront. Today, our profession has acquired an indispensable position in business and economy. ICI continuously aims at developing knowledge age so that the members stand out to the expectations of the society. To achieve this objective, the CP committee of ICI has been continuously striving for perfection, integrity, and knowledge, which makes the word chartered accountant synonymous with excellence in service. In this direction, the CP committee has always been proactive to the emerging needs of its members, enabling them to acquire contemporary knowledge and skills to face the challenges effectively by organizing CP programs and providing adequate opportunities. CP committee kindly request you all to participate in completing a small feedback form to provide your valuable inputs on CP guidelines and mechanism, and the same can be found on the CP committee page of ici.org under the What's New section and also on cpici.org. The program for this evening is as follows. We have two sessions of 1 hour each, and the topics are: first, understanding nuances of industry standards note on related party transactions under SEBI LODR. And the second one is assets related Ind AS practical issues. Our eminent speakers, CA Kamal Garg sir and CA Bhupendra Mantri sir, will talk about the above mentioned two emerging areas of professional interest. Now we have with us our esteemed chairman, vice chairman of the CP committee, CA Vishnu Kumar Agrawal sir. He is a Central Council member of ICI. He currently serves as Vice Chairman of the CP and Direct Tax Committees. He has a 20 plus years of experience in income tax. He is also the author of Landmark Judgments of Income Tax. He actively contributes to social causes and is highly respected for his professional and community involvement. Now, I request you, sir, to kindly address the gathering.
Thank you, madam. Respected today's speaker, Kamal Garg ji, Bhupendra Mantri ji, our moderator for this particular session, and the managing committee member from Indore branch, Madam Nidhi Bang, and our coordinator for this session, our office, Ajit Tiwari ji and his team. I welcome all the members today present in this webinar. Friends, every Friday we organize for our best of the practice 2 hours session for our members. Friends, today both of the speaker, I'm sure that they will crystal clear about our fundamental of the subject. Friends, already our Madam Nidhi Bang has already apprised about the committee and all the speakers. So I will not stand between you and the speakers because we have all limited time periods of the 2 hours. And straightway, I request Kamal Garg ji to take the subject. And friends, just only I say, in this 2 hours program, whatever we are organizing in every Friday, our speakers, we try at our level best to tops of the top speaker from across the country, and that's why we have taken the Kamal Garg ji and Bhupendra Mantri ji, and they have given the time to us. So we are also thankful to our speaker Kamal Garg ji and Bhupendra Mantri ji. They have given the time to our profession. Friends, and I welcome Kamal Garg ji and Bhupendra Mantri ji once again, and I handed over this subject to Kamal Garg ji.
Thank you, Vishnu, for this warm welcome. Thank you, Nidhi ji, for starting the session and kicking off it. And I'm thankful to Ajit ji also for accommodating my time as per the schedule given today. The topic given to me is about industry standards note vis-a-vis Regulation 23 of SEBI LODR. In this era of standards, we have accounting standards, we have Indian accounting standards, we have ICDS, income computation and disclosure standards, we have auditing standards, and in the presence of Vishnuji, being a Central Council member, maybe some more standards are going to come up in future. Now, with all these plethora of standards, SEBI also came up with a standard, industry standard note. Now, you being chartered accountant, most of you may be thinking that being chartered accountants, why we are worried about LODR and industry standard note. It's not the question of worry, it's the question of understanding. For example, the listed companies are required to disclose in notes about the transactions with related parties. Then as auditors, we have to report under company's audit report order, para number 3, subpara number 13. Now, when this reporting requirement is there, it is quite ideological and it's quite imperative that we must also understand the nuances of what LODR do say. So before I share my screen and say a few words about LODR, Nidhi ma'am, because you are the moderator, should you want to say something before I take up the session, or shall I start?
Yes, sir. I want to introduce you. Definitely, you are our eminent speaker. So to start with the first session, we have with us CA Kamal Garg, sir, and it's my absolute honor to introduce you, sir. He is a FCA, DISA, MCOM, and insolvency professional with expertise in corporate laws, audits, and management consultancy backed by extensive industry experience. He is a regular faculty and guest speaker at ICI and ICSI seminars and webinars with international exposure, including a session for the National Board of Accountants and Auditors, Tanzania. He is author of multiple professional books on IFRS, Audit, Companies Act, and IBC, published by reputed publishers like Walters Kluwer and Bharat Law House. Now, I would like to request you, Kamal Garg, sir, to take over the session. Please, sir.
Thank you, Nidhi ma'am. So I would share my screen within a few minutes from now. Let me set the tone why this industry standard note is important. Please try to understand in a very layman sense. Say, for example, there's a company XYZ Limited. It is a listed company and it is going to enter into certain transactions with parties which are related. Now, when you enter into transactions with parties related, certain approvals are required. When I say approvals, these approvals are from audit committee or the shareholders, as the case may be. I'm talking about listed companies. That's why I'm saying about audit committee. Now, the problem arises. What is the problem statement? The problem arises, suppose that I am the company secretary or I am in the secretarial team of a listed entity, and I wish to enter into certain transactions with parties related, and that's why I need approval from audit committee or shareholders, as the case may be. What are those approvals? We will see in a while. I need to give some information to my audit committee. I need to give some information to my shareholders also, or you can say as a layman, inputs. So for example, if Nidhi ma'am is the chairperson of audit committee and I need approval of audit committee for certain RPTs, RPT stands for related party transactions. Now question arises, as the chairperson of audit committee, along with other members of audit committee, how this audit committee will ascertain and decide whether approval should be given or not for a given RPT. And that's why different companies were following different practices. They were giving the information and inputs to the audit committee and to the shareholders as per their own whims and fancies. To bring in that uniformity, that all the listed companies now need to give only the uniform set of information and inputs, this industry standard note is being inducted. Now, the question arises, what to do as a chartered accountant and what to do as a company secretary. Quite obviously, company secretaries will compile all these things, which I will just discuss with you in a while. Auditors also need to be on the toes, because when they will audit, the discussions which happen in audit committee and which happen in shareholders body meeting, they form the audit evidence for the purpose of their reporting and for the purpose of examining the disclosure practices. I do now share my PPT to discuss all these things in detail. Just give me a second. Nidhi ma'am, is my screen visible? Can you please confirm?
Yes, sir.
Okay. So this is the topic given to me, understanding nuances of industry standards note on RPTs, that is related party transactions under SEBI LODR. SEBI LODR stands for Securities and Exchange Board of India, Listing Obligations and Disclosure Requirements Regulation. So for our context today, Regulation 23 is important because Regulation 23 of SEBI LODR deals with related party transactions. Let me give you a bird's eye view as to what Regulation 23 deals with. Just see this table. So Regulation 23 deals with these nuances. Regulation 23(1) or 1A as the case may be. What they say, Regulation 23(1) or 1A as the case may be, what they say that the listed companies must have the policy on materiality of related party transactions and how to deal with such transactions. So Regulation 23(1) and 1A, they deal with that listed companies must have the materiality policy vis-a-vis RPTs. Now, when I say Regulation 23(1) and 1A, it deals with materiality respectively for general transactions and payments with respect to brand usage or royalty. Now, what the law says in Regulation 23(1) and 1A, Regulation 23(1) says a transaction with related party, I emphasize, a transaction with related party shall be considered material if the amount involved exceeds rupees 1,000 crore or 10% of annual consolidated turnover of the last year, whichever is lower. So first I will compute rupees 1,000 crore or 10% of last year consolidated turnover. Then I will compute whichever is lower of these two. Then if the amount involved in a RPT exceeds this threshold in general, then it will be considered as a material transaction. Howsoever, if your company is paying royalty or a brand usage payment to a party which is related, then materiality threshold is different. In such a case, Regulation 23(1A) says the materiality will be if the amount paid or the amount going to be paid exceeds 5% of last year consolidated turnover. In that very case, it will be considered as material transaction. It may happen that certain listed companies might not have any subsidiary or associates. So in such a case, consolidated results will not be available. Then this word consolidated will be read as standalone turnover. So 23(1) and 1A deals with policy on materiality of RPT, and this policy is required to be approved by the board of directors, and all listed companies must have these policies. Then comes Regulation 23(2), 23(3), and 4. This green portion is relevant for industry standard note. I repeat and emphasize this green portion dealing with Regulation 23(2), Regulation 23(3), and Regulation 23(4). This green portion is relevant for industry standard note, and this green portion is the foundation due to which industry standard note was issued. Now, what does Regulation 23(2) deals with? Regulation 23(2) says approval of audit committee is required. Approval of audit committee is required for all the RPTs, even if they are not material. And this approval must be a prior approval. Similarly, if you wish to modify the terms and conditions of RPT, then again, approval of audit committee is required. Just see again, Regulation 23(2) says approval of audit committee is required for all the related party transactions, including the modifications thereto. And this approval is required even if the transaction amount involved is immaterial. Now the question arises, when we say approval of audit committee is required, who will approve? So we need to understand only the independent directors who are the members of audit committee shall approve RPTs. So there could be a possibility that in audit committee there are, let us assume, 8 directors. And out of 8 directors, let me assume 6 are independent directors. So only 6 independent directors are given the authority to approve or disapprove RPTs. And that's why I'm writing in the brackets, approval of audit committee comprising of independent directors only. Others will not be included for the purpose of RPT. They will approve RPTs, and this approval is required for all the RPTs. It is totally irrelevant to assess here whether this RPT amount is material or immaterial. Now, Regulation 23(3) is omnibus approval. So there could be certain situations whereby the transactions which will happen in future with RPT may not be foreseeable as of now. So in such a case, a blanket approval may be desired. So in such a case, if blanket approval is given, technically it is called as omnibus approval. So generally, omnibus approval is given by audit committee for repetitive nature of transactions, and the approval's validity stands for maximum 1 financial year, and audit committee need to specify criteria also on which basis this omnibus approval will be given. So in Regulation 23(2) and 23(3), primarily approval of audit committee is involved. If you see minutely Regulation 23.2 and Regulation 23.3, they are simply saying that you have to obtain approval of audit committee as per the required situations and conditions. But Regulation 23.2 and 23.3 are silent about the piece of information, about the inputs that must be given on the table of audit committee so that they can decide whether to approve RPT or whether to disapprove RPT. On the same front line, we have Regulation 23.4 also. Regulation 23.4 says if RPTs are material, then shareholders' approval is also required. And this approval is required by virtue of ordinary resolution, but there is a condition. If certain shareholders are parties related, then they are not allowed to vote on such approval. So 23.4 deals with approval by shareholders. Please understand and underscore, approval of shareholders always is not required. We require the approval of shareholders only when the transactions are material. As we discussed earlier, what is materiality? Materiality needs to be assessed for general transactions and specific transactions. For general transaction, amount shall be considered as material if it exceeds rupees 1,000 crore or 10% of last year's annual consolidated turnover, whichever is lower. And in case of royalty payments or brand usage payments, the amount shall be considered as material if it exceeds 5% of last year consolidated turnover. So simply putting, the rule is audit committee approval always required. Shareholders approval required only if the transactions are material. Now again the same thing I will repeat. Even in Regulation 23.4, nothing is written as to what should be on the table of shareholders as inputs and information, basis which they will consider to grant approval for RPT or they will disapprove RPT. Because this piece of information or inputs are not specified by Regulation 23.2, Regulation 23.3, and Regulation 23.4, a need was felt by SEBI that there must be some standardization. And keeping this thing in mind, ultimately what happened, industry standards note was issued. And this industry standard note is prepared by Industry Standard Forum, which is a consortium of ASSOCHAM, CII, and FICCI. And this consortium, which is popularly called as Industry Standards Forum, they, under the aegis of stock exchanges and thereafter consultation with SEBI, devised some questions. I will discuss those questions in a while. Devise some questions and some format whereby the minimum information that needs to be provided to audit committee for their review and shareholders for their approval has been laid down. So what happened on 14th of February 2025, this year itself, SEBI amended its circular dated November 11, 2024, and this industry standard note was mandated. And what is saying? So I will read it for you. The listed entity shall provide, the word is shall provide the audit committee with the information as specified in industry standards. Similarly, the industry standard note also says the notice being sent to shareholders seeking approval of any RPT shall, in addition to the requirements under the Companies Act, include the information as per explanatory statement as specified in industry standards form. Primarily, what is the crux coming out? By virtue of this SEBI circular dated 14th February 2025, industry standard note is giving two sets or two sections, section A and section B. I will just show you. And that section is section B is seeking some information from the corporate house. And this information needs to be filled in section A and section B, and then it's need to be submitted to audit committee for the review and approval. And similarly, where required, this information also needs to be submitted to shareholders for their approval. As I stated earlier, audit committee approval always required. So whenever you will be having RPT, that questionnaire always need to be filled in and produced before audit committee. But whenever transactions are material in nature, then only that questionnaire or industry standard note questionnaire will be submitted before shareholders also. So before I proceed further with the discussion, let me show you the questionnaire. Nidhi ma'am, are you able to see a new screen PDF document of NSE?
Yes, sir.
Okay, so this is the circular issued by NSE, and the same way circulars are issued by BSE also. And this circular says that you have to comply with industry standard note. And just see the SEBI circular. This is the SEBI circular of 14 February. Once I scroll it down, this is the industry standard note. Now, when you scroll this file further, industry standard note is having a questionnaire. I'm showing you in a second. Just see. This is the questionnaire in para 4. So this para 4 deals with questionnaire given by industry standard note. In this questionnaire, total 106 questions are there. And these 106 questions need to be filled in. How this filling will take place, that is not the agenda of the day, but what and when you have to fill in is the agenda of today's session, which I will discuss in a while. In this para number 4, this format is being given, popularly called as a questionnaire or ISN questionnaire, and you will fill in this information, you will invite comments of the audit committee, and then proceedings will further take place. So total 106 questions are there. If I go towards the end, just see total 88 questions in section B. This is section B. And if I go to page number 10 once again, so this is section A. Section A is having total 18 questions. Question number 1 to this question number 18. So total 18 questions are here. Then we have section number B. Section number B starting from question number 1. And if I go towards the end, total questions are 88. So total 106 questions are there. So as auditors, as company secretaries, we need to be very meticulous about these 106 questions. So now we have to discuss what these questions are demanding and warranting and how to analyze further. So if I give a introduction about this ISN further, the title of this ISN is minimum information to be provided for review of audit committee and shareholders approval of RPTs. RPT stands for, as I told you, related party transactions. When the circular was issued, initially, the applicability date was kept at 1st April 2025. So originally, when the circular was issued, the date of applicability was kept at 1st April 2025. But as per industry demand, and to allow some more time to the industry, SEBI accepted the demand and SEBI issued a circular on 21st of March 2025, whereby this date, 1st April 2025, has been extended to 1st July 2025. So whatever we are going to discuss today about the questionnaire, that is applicable from 1st July 2025. In my personal view, the time is being granted, but still the time is not in plenty, and we have to prepare ourselves as a professional fraternity a lot. Now, what is the objective and purpose of this industry standard note on RPT? As I told you, the same objective and purposes are outlined here also. To standardize the format for minimum information to be provided to the audit committee and the shareholders wherever required for review and approval of RPT. The information provided in this standardized format shall be incorporated into the agenda of audit committee meeting. So whatever questionnaire we will be discussing, that needs to be a part and parcel of agenda of audit committee meeting as well. The comments of audit committee needs to be invited where applicable, and they shall be recorded in the minutes. And as I told you, for material RPTs, as we know that shareholders approval is also required. So for material RPTs, the information is prescribed in these standards shall be included in explanatory statement to the notice and to the shareholders. So whenever general meeting is appointed, we need to send the notice. And for these material RPTs, along with that notice, we have to provide the explanatory statement as well as per this industry standard note. And there could be a scenario whereby the information as warranted and required by industry standard note may be inconsistent with LODR or any of the SEBI circular. So it is very clearly given in the industry standard note. Wherever such kind of inconsistency is there, then LODR regulations or SEBI circular, as the case may be, shall have the prevailing or overriding effect. Now, when I proceed further, the whole industry standard note can be discussed in these 5 headings. Heading number 1 is applicability of these standards. Heading number 2 is standards for definitions of words and expressions used in these standards. Number 3, standard for minimum information to be provided to the audit committee for review and approval, including ratification of RPTs. Number 4, format for minimum information to be provided for review of audit committee for approval, including ratification thereof. And lastly, standards for minimum information to be provided to shareholders for consideration of RPTs thereof. Now, in this industry standard, a new concept is being introduced, which is popularly called as promoter and promoter group interest entity. We'll discuss that thing as well. Let us first discuss applicability. Be very careful because now the things will become a bit tricky. Applicability of these standards. So industry standard says the transactions need to be categorized. The transactions need to be categorized into 3 categories. I repeat, the transactions need to be categorized into three categories. Category number one is called as material RPT. Category number second is called as ORPT. ORPT means other RPT. And category number third is called as RRPT. That is residuary RPT. On this screen, you are observing two first class of RPTs, that is material RPT and other RPT. Now, material RPTs are those RPTs which are defined under Regulation 23.1 and 23.1A, which we have just seen. 23.1 says amount shall be considered as material if it exceeds the lower of rupees 1,000 crore or 10% of the turnover, that is consolidated turnover. Let me show you once again. This is the criteria. And for brand usage, the criteria is more than 5% of annual consolidated turnover of the last year. So this is Regulation 23.1 and 1A called as material RPT. Then is other RPT. Other RPT, sometimes it is called as applied criteria RPT. Now what the standard says, transactions with a party which is related, where transactions entered into individually or taken together with previous transactions during a financial year. So if we are standing in the financial year, say 24-25, then all the transactions with a particular RPT needs to be clubbed. But this circular is applicable and ISN is applicable on 1st July 2025. So what will happen? All the transactions of 25-26 will be aggregated. So it is not only the individual transaction with RPT, but all the transactions put together with RPT during the financial year exceed lower of the following. So lower of these three, if the amount involved with the RPT exceeds these three or any of these three, then it will be called as ORPT, that is other RPTs. What are these criteria? 2% of turnover as per last audited consolidated financial statements of listed entity. As I told you earlier also, if listed company is not preparing consolidated financial statements, then obviously standalone financial statements will be taken. Then is 2% of the net worth as per the last audited consolidated financial statements. The same analogy will be drawn here also. If standalone financial statements are only there, then that will be taken up. However, please remember, they said 2% of the net worth. But if net worth is negative, then that shall be ignored. So except in the case of arithmetic value of net worth, where it is negative. Then is last one, 5% of average. Now be careful. In this first 2% criteria, average is not there, but when it comes to last criteria, 5% criteria, average is there. And that too not simple. 5% of the average of profit or loss after tax. But which profit or loss after tax? Absolute value of profit or loss after tax as per the last three audited consolidated financial statements. This calculation need to be precautioned. Let us take a situation number one. In year one, the profit is rupees 10. When I say profit means PAT, profit after tax. In year one, let us assume the profit is 10 rupees. Year second, it is 15 rupees. And year three, it is, let us say, 15 rupees. So it will be 10 plus 15 plus 15. That is 40 rupees. 40 rupees divided by 3. We will compute the average. It will be somewhere around 13 rupees. Now, average will be 13 rupees here. Now, let me change the scenario. Assume that year one profit is rupees 10. Year second loss is rupees 15. So it is minus 15. And then year three again. Let us say profit is rupees 15. Now, how to compute average? And in this second situation, you will compute average. You will not do 10 minus 15 plus 15. Rather, you will take absolute value. Now, when I will take absolute value, what will happen? It will be again the same way. 10 minus 15 will become plus 15, and then plus 15 divided by 3. And then I will apply 5%. So be very careful. Here it is not the simple average of simple numbers. It is the average of absolute numbers. So if it is a minus figure, it will be taken as absolute figure to be a positive figure. When you will compute this 2 to 5 criteria amounts, lower of these three will be taken up. And if the transaction with RPT exceeds this 2 to 5 criteria, then it will be covered by other RPT. Now, please remember, once a transaction qualifies itself as material RPT, then do not classify again it into other RPT. So once a material RPT, it will remain in material RPT only. No need to club it with other RPTs. Now, third one is residuary RPT. What is residuary RPT or RRPT? If any transaction is not falling into MMRPT or ORPT. I repeat, if any transaction is not falling into material RPT or other RPT, then it will be falling into a default category, which is, or balance category, which is residuary RPT. So simply putting, first check whether transaction is material or not. Second, check whether transaction is within the applied criteria bracket or not. If it is not here, then it will go into residuary RPT. Now, what is the applicability matrix? As I told you that we have total 106 questions to be answered in the questionnaire. When we say 106 questions to be answered, the standard further says the questionnaire answers can be of three categories again. Questionnaire answers can be of three categories again: comprehensive category, limited category, and minimum category. When I say comprehensive category means all the questions need to be answered. So all the 106 questions need to be answered. That will go into comprehensive category. When I say limited category means out of 106 questions, some questions either are not required to be answered or are required to be answered but with little information only. I repeat, comprehensive means all the questions need to be answered. That is question number 1 to question number 106. Limited means out of 106 questions, either you will answer all the questions or you will answer few questions or you will answer all the questions but with little information. So when, let us say, some information is required for last 3 years, but standard says for a given question, instead of giving information for last 3 years, give information only for 1 year. That will be called as limited answer or limited information. Similarly, if the question says I need not be answered, it will go into limited disclosure or limited answer. Then third one is minimum. So as I told you, three kinds of answers could be there: comprehensive answers, limited answers, or minimum answers. Now, when I say minimum answers means that you need to answer only a few questions. Other questions need not be answered at all. I repeat, other questions need not be answered at all. So minimum information means a lot of relief is being given, that no other questions need to be answered, only few questions need to be answered. So now we need to understand when we need comprehensive answers, when we need limited answers, and when we need minimum answers. So when it is a case of material RPT. Now, what is material RPT? That RPT which falls in the regulation 23(1) and 1A. Transactions could be falling into balance sheet items or P&L items. Now, what is balance sheet item? What is P&L item? A list is again given. So if balance sheet items and P&L items are there and they're material, so the standard says in respect of material RPTs for balance sheet and P&L items, you may be requiring approval of audit committee and shareholders as the case may be. Then comprehensive disclosures are required. So for material RPTs, nothing doing, you need only comprehensive disclosure. So all the questions need to be answered. So question number 1 to question number 106, all the questions need to be answered, and this will go into comprehensive category. So always remember, material means comprehensive answers. Then it's other RPT. Now, what is other RPT? Other RPT means the RPT which is falling within the applied criteria bracket. What is that applied criteria bracket? That is 2 to 5 criteria. That is this criteria. So if the transaction is falling into applied criteria, it may either exceed the applied criteria or it may be less than applied criteria. It may be balance sheet item or it may be P&L item. Now, please understand, although this other RPT is falling in applied criteria or is falling out of the applied criteria, shareholder approval is never required. Why shareholder approval is not required? Because it is not a material RPT. So if it is not a material RPT, but it is other RPT, then only we need audit committee approval for balance sheet items as well as P&L items. But the question arises, for balance sheet items and P&L items, are we supposed to answer all the questions or we are having some relief also? For this purpose, the standard says for other RPTs, you need not only assess applied criteria, but also check whether the RPT is taking place with a party which is a promoter or promoter group entity. What is promoter group entity? I will discuss in a while. So if I am entering into a transaction with you and you are my party related and you are also a part of promoter group or promoter, then what will happen? If my transaction with you is exceeding 2 to 5 criteria or applied criteria, then we need to give comprehensive answers. It doesn't matter whether it is a balance sheet item or P&L item. So for balance sheet questions as well as P&L questions, for balance sheet questions as well as P&L questions, I will be giving comprehensive answers. I repeat, listen once again. If I am entering into a transaction with you, you are my party related, but at the same time, you are my promoter group party. In such a case, if the amount involved exceeds applied criteria, that is that 2 to 5 criteria, then we need not see anything. Always we need comprehensive answers. Doesn't make a difference whether it's a balance sheet based questions or a P&L based question. Howsoever, if I am entering into transaction with you, you are my party related, and you are my promoter group entity as well. But at the same time, the amount involved is less than applied criteria, that is 2 to 5 criteria. Then for balance sheet items, the questionnaire needs comprehensive answers. That means in totality, we have to give the answers. But for P&L items, some relief is there. We need to give only limited answers. You can remember like this, for balance sheet items, whether it is a material RPT or other RPT, always comprehensive answers are required. It is only for P&L items in less than applied criteria category with promoter group, we need limited answers. Number third, if it is RRPT, that is residual RPT, then irrespective of whether it is a balance sheet item or P&L item, but we have to see only audit committee approval is required. But if amount involved is more than rupees 1 crore, we need limited answers. If the amount involved is less than rupees 1 crore, then we need minimum answer. I repeat, if it is a residual RPT, what is residual RPT? The RPT which is neither material RPT nor other RPT. Then for balance sheet items and P&L items, no need to go here and there. We will simply check whether the amount involved is more than rupees 1 crore or less than rupees 1 crore. If it is more than rupees 1 crore, then we need to give only limited answers. If it is less than rupees 1 crore, then we need to give only minimum answers. I believe up till now, this distinction is clear. So what we discussed, let me recap. Let me type on the screen. Filling questionnaire is not a problem. Understanding whether it is comprehensive information to be given, limited information to be given, or minimum information to be given, that is the real challenge which we need to first of all make clear. So what we understood, distinctions. This distinction must be clear in minds. Distinction first is material versus other versus residuary RPT. Other distinction which we discussed, comprehensive versus limited versus minimum. These are the two major distinctions which we have discussed. Up till here, if you have any problem, you may send the questions to the office. They may ask questions to me. Nidhi ma'am, if there is any question up till now, you may please pass on the questions before I proceed further.
No, sir. Abhi tak nahi.
Okay. Now, having understood what is material RPT, what is other RPT, and what is residuary RPT, and having understood what kind of answers we have to give, comprehensive answers, limited answers, or minimum answers, let us move forward to understand when a person shall be considered as a person in the promoter or promoter group. So the standard, that is industry standard note. Industry standard note has stated, person in which promoter or promoter group has concern or interest, if they in any way, whether directly or indirectly, where the person is a body corporate, holds more than 2% shareholding or voting rights of that body corporate, or the person is a body corporate and is a promoter, MD, manager, CEO of that body corporate. So if I give a very simple layout, suppose that there is a body corporate and that body corporate holds more than 2% shareholding in that body corporate, then this body corporate will become promoter group entity. Now, if individual is there and that individual is a promoter or MD of other body corporate, then that will also become promoter group entity. On the other hand, if the other person is a firm or other entity. So, for example, if you are a partnership firm, and in this partnership firm, the promoter or promoter group is a partner, owner, or a member, then that partnership firm will also become promoter group entity. Let us understand this concept of promoter group entity through some examples. So I give before you one case study. So let us assume the listed entity is Avanta Steel Limited. Let me give a disclaimer. All these names are hypothetical and purely academic, just for the sake of your understanding. So if I assume that listed entity is Avanta Steel Limited and the promoter group entity is Khurana Holdings Private Limited, any person that is a target entity is Neorail Technologies Limited. So these three entities are given. What are the facts? Khurana Holdings, that is a promoter group entity, as the question itself has stated, Khurana Holdings, that is a promoter group entity, holds 5.4% equity in Neorail Technologies Limited. What is Neorail Technologies Limited? Any person, that is a target entity. What is the RPT transaction? Avanta proposes, so this listed entity, Avanta, proposes to invest in Neorail's convertible debentures. Now, what is the implication of industry standard note? Since promoter group, what is the promoter group? Khurana Holdings. Since promoter group holds more than 2% in Neorail, Neorail is a body corporate, it is deemed as promoter group interest entity. So what is the disclosure obligation? Transactions becomes RPT with promoter group interested entity and hence apply 2 to 5 criteria to determine the disclosure type. I believe this must be clear to each one of you. Because it is not, because it is a other RPT with the promoter group entity, 2 to 5 criteria will be applied, and depending upon that, either we will give comprehensive disclosures or limited disclosures. Please underscore my words that promoter group interest entity needs to be identified. That is a kind of new requirement of ISN. Let us take case study number 2. So listed entity here is Nexora Mobility Limited. Promoter is Mr. Rishabh Khurana. Any person that is target entity, let us say Tevex Realty partnership firm. Now facts are Mr. Khurana is a partner in Tevex Realty. Now what is the RPT proposed? Nexora leases office from Texas Realty. Now what are the implications of ISN? Texas is deemed as PGIE, that is promoter group interest entity under ISN. So what is the disclosure obligation? Since PG is a partner, RPT with Tevex requires disclosure and threshold testing. Threshold testing means that 2 to 5 criteria. So what we discussed in case study number 1 is this left-hand side, body corporate, and in case study number 2, it is right-hand side, that is firm. One more case study. Let us assume this entity is Triline Beverages Limited, promoter group entity is Eastern Agro LLP, any person that is the target entity is Shakti Farmers Cooperative Society Limited. Now the facts are Eastern Agro LLP, that is the promoter group entity, is a member and sits on the management committee society. So what is the RPT transaction given here? Triline sources 40% of sugar cane from society. So what are the implications under industry standard note? Society is deemed as promoter group interest entity as PG is the member. Again, the same answer. Disclosure obligation, or I should say questionnaire information required is transactions must be evaluated under ISN as PGIE is related and apply 2 to 5 threshold and accordingly decide whether it will be a limited disclosure or a comprehensive disclosure. Now be very careful for question number 4 or case study number 4. Individual. So listed entity is Arinva Textiles Limited. Promoter is Ms. Richa Verma. Any person is Mr. Aditya Verma, her brother. So both are relatives. Now the facts are Mr. Aditya runs a consultancy business and provides services to Arinva. RPT transaction is Arinva, that is this listed entity, pays him rupees 2 crore per annum as brand advisor. Implications under ISN, be very careful here. ISN deeming clause. What is the deeming clause? This is the deeming clause. This is the deeming clause. So what the law says? Law says about body corporate, firm or other entity. It is absent about individual. So individual is not mentioned here. Individual is not in left hand side. Individual is not in right hand side also. So that's why this case study is important. ISN deeming clause does not apply since Aditya is an individual. However, he may still qualify as party related under section 2 clause 76 of Companies Act or Ind AS 24. Disclosure obligation applies standard RPT test. That means other RPT test is not applicable because promoter group or promoter group entity concept is not applicable when the target entity is individual. So ISN deeming clause is not triggered unless routed through firm or company. So in real world, please be very careful. If the target RPT is with a target RP, which is individual, then this promoter group concept will not be applicable because it is applicable only when the target entity is either a body corporate or a firm or any other entity. Having said that, let us have the look out on the structure. As I was telling, that total 106 questions are there. These 106 questions in ISN language are called as row items. So I can call it as a row item or questions for the sake of understanding, doesn't make any difference. I will use question number only for that because that will be a bit simple. As I was telling you, total 106 questions are there. 18 plus 18, 18 plus 88. 18 means section A questions, 88 means section B questions. These 106 questions need to be answered either comprehensive way or limited way or minimum way. Now, when I say comprehensive, it means all the questions need to be answered. When I say limited, all the questions need to be answered except these 4 elements. Just see very carefully. So when I will be into the limited scope of disclosing answers to my questions, then in limited scope, I will be disclosing all the answers, but these answers are not required. For example, section B, subsection 2, question number 13 to 70. I am using the word question, but the technical word in ISN is row item. So section B, subsection 2, question number 13 to 17. These questions deal with invitation of bids. So invitation of bids information. So if I am entering into a contract with a party related for purchase of goods or selling of the goods, then bids need to be invited. Now that bid information need not be given when I am into the limited scope of answering. Then if I am into the limited scope of answering, section B, subsection 3, question number 31 to 32. They require last 3 years information for borrowings and interest. Now, if you are into the limited scope, then 3-year information is not required. Only last financial information is required. Similarly, if I'm into the limited scope of information, then in section B, subsection 4, B4 means section B, subsection 4, question number 43 or row number 43, which deals with investment into shares and debt. So if there is any such kind of investment in share and debt of a party related, then all other questions need to be answered, but question number 43 need not be answered. Question number 43 deal with asset liability mismatch. Similarly, if I am into the limited scope information, then all the questions need to be answered except section number B, subsection number 8, question number 78, question number 79, question number 84, and question number 86. These 4 questions need not be answered. These 4 questions deal with payment of dividends, royalty, and peer comparison. So if you have paid royalty, you have to give information about the peers, how much royalty those peers in industry are also paying. So that information is not required when you are into the limited scope of information. Now, third is minimum. So if you are into the minimum scope of information, then you have to give disclosures. As are specified in A1, A2, A4. Just see A3 is missing. A1, A2, A4, A5, and B1. So only this disclosure is required. So you need not give comprehensive disclosure or limited disclosure. All the disclosures other than these, A1, A2, A4, A5, and B1 are truncated when you are into the minimum scope of disclosure requirements. Now, how to make an analysis? So what is this A1, B1, and so on? A1 deals with basic details of the RP. A2 deals with relationship and ownership of the RP. A3 deals with financial performance of the RP. Just see the words financial performance of the RP. As I told you, this A3 is missing here. No? Just see A3 is missing here. So that means A3 information need not be filled in the questionnaire in case you are into the scope of minimum disclosures. A4, details of previous transactions with the RP. A5, amount of proposed transactions. All types of transactions need to be taken together. B1, basic details of the proposed transaction. Now, standard says in case of multiple types of proposed transactions, details to be provided separately for each, just see the word each type of proposed transaction. For example, sale of goods and purchase of goods to be treated as separate transactions, sale of goods and sale of services to be treated as separate transactions, giving of loans and giving of guarantee to be treated as separate transactions. So that information you need to give in B1. Basically, it is a proposed transaction. The word is proposed. So whatever transactions are already undertaken, they need not be disclosed over here. This is A1, A2, A3, A4, A5, and B1. Now, the standard further deals with some balance sheet items. So this is called a general information. Now, we have the list of balance sheet items as well as P&L items. So in balance sheet items, B3 deals with loans, intercorporate deposits, or advances being given. Now, if you are into the limited scope of information, for B3, question number 31 and 32, you need to give information for last 1 year only. 3-year information is not required. That's why 3 previous year are struck off. B4, balance sheet item B4. B4 deals with investments being made by the company in RPT. It includes investment in debt instruments also. If you're into limited mode, question number 43 is not required. So if I go back, just see here, question number 43 was dealing with asset liability mismatch. This is not required. Then B5, guarantee information, comfort letter information, indemnity information, surety information required. So no leverage here, no relief here. Only relief is minimum information. So nothing is minimum here. So B3, B4, B5, B6, B7, nothing goes into minimum. If I show you, just see the top. On the top of this clip, the heading is containing no minimum information from this part. So from this part, balance sheet part and P&L items, no minimum information is traveling to your disclosure questionnaire. Then B6 is borrowings. B7 deals with sale, lease, or disposal of assets of subsidiary or of unit, division, or undertaking of listed entity, or disposal of shares of subsidiary or associate. Now, when it comes to P&L items, B2 deals with shares. Sorry, B2 deals with sale, purchase, or supply of goods or services, or any other similar business transaction. As I told earlier, let me reiterate, if you are into the scope of limited disclosure, then no information need to be given for question number 13 to question number 17 in B2 category. B2 category is dealing with, just see, bids. So no bids information is required to be given when it comes to B2 category in limited information. Payment of royalty B8, you have to give the comprehensive disclosures, minimum not required for this place. But if you are falling into limited scope, then question number 78, 79, 84, and 86 are also not required. That is what the entire layout of this balance sheet P&L items are there given in industry standard note. So if I say it again, industry standard note can be divided into 2 categories further. General information, this is general information, A1 to B1. A1 is having 5 subsections, and B1 is section B is having, section number B is having total 8 subsections. These 8 subsections are further having a categorization of general information, that is B1, then certain balance sheet items and certain P&L items. This is the entire layout of the questionnaire. Let me show you the questionnaire once again. You see this questionnaire, you may be able to see the PDF document. So this is the questionnaire section A. This is general information A1, A2. Then this is A3, financial information. As I told earlier, let me reiterate, this A3 is not a part of your minimum disclosure requirement. So if you are falling into minimum disclosure requirement, this A3 need not be filled in. Similarly, A4, then A5, this comes to an end, then is B, section B, then B1, B2, and so on will go again and again. Let me come back to the PPT. Consider this case study. Having understood this entire layout, let us understand the case study, how to identify whether any transaction will go into comprehensive disclosure or minimum disclosure or limited disclosure. Let us move one by one. So this is the case study as a basis. Nexora Mobility Limited is the name of the listed entity. It is into the industry of electric vehicles and clean energy, and it is listed on NSE and BSE. Now, the financial profile is given. Consolidated turnover for the last year ending on 31st March 25 is 2,100 crores. Net worth is 780 crores. Average profit after tax of last 3 years is 145 crores, and promoters holding is 53%. Let us proceed further. So for the sake of workings, let us compute Regulation 23(1) material transactions, that is rupees 1,000 crores or 10% of consolidated turnover. So 1,000 crores or 10% of consolidated turnover. That is this 2,100 crores, it will be rupees 210 crores. So it is 210 crores. Whichever is lower, it will be 210 crores out of 1,000 and 210. 210 crore is the threshold limit. 23(1)(a), if I go to brand royalty payment, then 5% of consolidated turnover, so 5% of 2,100 crores is 105 crores. So 23(1) and 1(a) came here. Then for promoter group entities concept, we have applied criteria. Applied criteria is 2 to 5. 2 to 5 means 2% of turnover, 2% net worth, and 5% of PAT, whichever is lower. So 2% of turnover is 42 crores. 2% of net worth. No matter how much is the net worth, 780 crores. So it is 15.6 crores, and 5% of PAT. What is the PAT amount given? Average PAT is 145 crores. So it is 7.25 crores. Lower of these two is 7.25 crores. That is the basic working. Now, just give me 5 more minutes and everything would be quite easy for you. Just see here, RPT classification, sale of goods. So these are the 5 transactions given to you. You need to help me in understanding whether it will go to material, other, or residuary. First is sale of goods. The sale of goods transaction is being proposed to be entered into with a party related, and this part is LODR Batteries Private Limited, promoter group entity, rupees 250 crores is the value proposed. Then is loan transaction and commercial paper investment transaction. 30 crores is the loan. Investment is proposed to be 15 crores with the subsidiary Luances Capital, and the amount involved is 45 crores. Then guarantee is proposed to be given to a bank in relation to Luances Capital, which is a subsidiary. Amount involved is 25 crores. Company also proposes to give loan to one LLP. LLP is a promoter group LLP. Name of the LLP is Ashara Holdings LLP. It's a PG entity, and amount involved is 20 crores. Other transaction proposes equity investment in a joint venture. This equity investment in joint venture is with Greenlit Asia, which is a PGIE, that is promoter group interest entity, and the amount involved is rupees 10 crore. So now I give you 30 seconds to analyze yourself, which will go into material, which will go into other, which will go into residuary, and which disclosure will be applicable, comprehensive, limited, or minimum. So Nidhi ma'am, you are the moderator. I need your answers also. So what kind of disclosures are applicable? Material, other, or residuary, vis-a-vis, comprehensive, limited, or minimum. So let me go to the answers. Just see here one by one. This will make things simple. First is sale of goods. Proposal is with the LODR Batteries Limited, Private Limited, which is a promoter group entity. Amount involved is 250 crores. Always check, first of all, whether it is a material RPT or not. Whether it is a material RPT or not. Yes, it is a material RPT because amount involved is 50 crores, and this 250 crores is more than this 210 crores. 23(1). So it is a material RPT. If it is a material RPT, always it is comprehensive. Always it is comprehensive, irrespective of whether it is a balance sheet item or a P&L item. Although in this question it is very much apparent, it is a P&L item. Now, loan transaction of 30 crores, loan transaction of 30 crores, and investment in commercial paper, 15 crore. Total amount is 45 crores. And it is the subsidiary. Subsidiary is a promoter group entity. By definition, is a promoter group entity. So now, again, the question arises, is it material? Answer is no. Why it is not material? Because 45 crores is less than 210 crores. So it is not a material transaction. Because it is not a material transaction, it will go into the second leg. The second leg is other RPT, that is with promoter group entity, and it is a balance sheet item. Now for balance sheet items, always comprehensive disclosures are required. So no leverage, you have to disclose all the answers. So that's why it is ORPT, specified balance sheet item, and comprehensive disclosure. Then guarantee to bank. Now bank guarantee is given to its subsidiary. Subsidiary falls into promoter group entity. Amount involved is 25 rupees, 25 crores. I mean, this 25 crores is material or immaterial? It is immaterial because it is not falling into regulation 23(1) or 1A. So it will go into other RPT, balance sheet item, comprehensive disclosure. Loan to promoter group LLP, same PG entity, amount is immaterial. It will go into other RPT, specified balance sheet item, comprehensive disclosure. Because for balance sheet item, we always give comprehensive disclosures if it is a PG or PGIE entity. Equity investment in JV. Equity investment in JV. Balance sheet item, yes. Is it material? No, because it is less than 210 crores. So it will go into second applied criteria category because it is promoter group entity involvement, and balance sheet item being present, it is always a comprehensive disclosure item. Let me take few more instances. Asset sale by subsidiary. Party related is Tevex Realty. Promoter group entity amount involved is 215 crores. Lease of office premises from PG entity Tevex Realty LLP amount involved is 9 crores. Technical services in Volta Global, it is an associate entity, non-PG amount involved is 3 crores. Salary paid to Mr. Rajan Khurana, promoter's son. So it is in companies that it is called as Office of Profit, amount involved is 0.28 crores. So what kind of disclosures are required? Let us analyze one by one. Asset sale by subsidiary. Is it a material amount? Yes, it is more than 210 crores. So we need not check whether it is a PG entity or not. If it is material, always it is comprehensive disclosure requirement under MRPT category. The lease of office premises. Balance sheet item, yes. Whether amount is material, no, because it is less than rupees 210 crores. And because it is with a PG entity, balance sheet item is involved, so comprehensive category item. And it is obviously it is more than that 7.25 crores also. What is 7.25 crores? The threshold of 2 to 5 criteria. So hence it is a comprehensive category item. Then is technical services. In Volta Global Associate non-PG. Amount involved is 3 crores. Now please see, rupees 3 crores is neither material nor falling into PG entity bracket, because it is not into the bucket of PG category. Where it will go to residuary category, RRPT. And what is this item? P&L item. So P&L item is limited. Why limited? Because it is more than rupees 1 crore. If I show you the applicability matrix again, just see the applicability matrix. If it is more than 1 crore of RRPT, then limited disclosure. If it is less than 1 crore of RRPT, then minimum disclosure. In my example, it is 3 crores of amount, which is more than rupees 1 crore. So it will go into limited category. Then salary paid to promoter son, 0.28 crores. The promoter group is involved. It is 0.28, but this 0.28 is below 2 to 5 criteria. So it is not within the applied criteria. It is less than applied criteria, and it is a P&L item. So it will go into minimum disclosures. It will go into minimum disclosure. It will go into RRPT because it is a non-specified P&L item. Why non-specified P&L? Just see. If you see this P&L list, in this P&L B2 and B8, salary payment is not involved. When B2 and B8 salary payment is not involved, then what to do? The question arises, if there are certain RPTs which are not falling into these B3 to B7 and B2 to B8, then what to do? These are called as non-specified items. So for those non-specified items, always it will be RRPT criteria, and this salary being paid to promoter's son, although it is a promoter category, but first of all, it is an individual, and hence promoter definition will not be applicable. Even if theoretically we assume definition is applicable, still it will remain outside this whole agenda of ORPT, because this RPT is not falling into specified balance sheet items and specified P&L items. So it will go into RRPT criteria on, and only minimum disclosures are required to be given. So please mark my words and you may take a note of it. There can be certain transactions which are not falling within this balance sheet and P&L buckets. Those RPTs which are not falling into balance sheet and P&L buckets, always they will be covered by minimum disclosure requirements, that is this clip. So you will disclose about A1, A2, A4, A5 and B1, no need to give A3. So this is the discussion from my side. I would suggest you, whatever I was planning to discuss, I have discussed in this 1 hour of time. I will suggest you to download the questionnaire from NSC website so that you can analyze and extrapolate whatever discussion I made with you on this session. So should you have any questions, I would be happy to answer. I'm stopping my screen share now.
Sir, there are no queries arrived yet.
Great.
I think you have explained it so well that no queries came up
There
at
can
all.
be two things, clear in mind or clear from mind.
Clear, no sir, clear in mind.
Any question from your side, ma'am, or any question from other panelists? I can see Bhupendra Mantriji, my good friend also, and my senior as well. So if any question from Mantriji's side, I would be happy to analyze and answer. Else it is 5. His time is there.
Now I would like to give a heartfelt vote of thanks On behalf of CP Committee of ICI, I would like to thank CA Kamal Garg sir for taking time out of their busy schedule to grace us with their presence and share their valuable insights with us. Thank you so much, sir.
Thank you, Nidhi ma'am. Thank you, CP committee. Thank you, Vishnuji, and thank you, Satish in absentia. Thank you, Ajit ji,
Thank you so
also
much, sir.
for accommodating
Thank you
this.
so much.
And thank you, Upendra Mantri ji, who also listened this program. I'm really glad to have my senior over here. Thank you very much.
Now, as we move ahead towards the second session, which is about asset-related Ind AS practical issues, for which we have with us the eminent speaker, CA Bhupendra Mantri sir. He has an expertise in IFRS, Ind AS auditing, and financial reporting with over 20 years of professional experience. He is the author of multiple publications in the Chartered Accountant Journal and a book on Ind AS published by Taxman. He has conducted over 250 ICI events, including national conferences, certificate courses, and various workshops. Now, I would request Bhupen sir to take over the session.
Thank you, Nidhi. Thank you so much for the brief introduction of mine, as well as thanks to the CPA committee for this opportunity to share certain issues related to the Ind AS, particularly in the Ind AS related to the assets. So what I will do is I will just touch upon that which of the standards I am covering up for taking up the various real life examples or the various issues which comes during the course of audit as well as while preparing the financial statements. I'm sure that presentation is now visible.
Yes, sir.
Okay, and it is moving also. Is it moving also?
Yes, sir, moving.
So friends, though it is hardly 1 hour to talk on asset related standards, but I would try to, try to dwell few of the practical issues which are there while we do the accounting as well as the present in the financial statements. So mostly my issues will be covered from these standards: Ind AS 2 inventory, Ind AS 16 PPE, then Ind AS 23 borrowing cost, 38 intangible assets, 41 agriculture, and then leases, and in last Ind AS 105 related to the non-current assets held for sale. So primarily these standards will be covered. And before I go to the various practical issues, I would like to, in fact, just summarize that what are the criteria for initial recognition related to the these Ind AS, as well as what are the criteria of subsequent measurement related to these Ind AS. And it is just for an overview. I'm sure that all participants know about it, but just to set the tone about my presentation over a time of 1 hour, I'm just telling you that what are the recognition criteria with reference to these assets. So inventories, as you all know, is recognized at cost, and subsequent measurement of inventory is recognized at cost or net realizable value, whichever is lower. And mostly the issue related to computation of net realizable value comes, which I will deal with while dealing with the various cases related to the Ind AS 2. Then property, plant and equipment, initial recognition is done at cost, and then subsequent measurement is done at cost model or the revaluation model. So I will not discuss this cost model or revaluation model at length so far as today's presentation is concerned. Then intangible assets Generally, if it is acquired intangible assets, it is recognized as cost. Of course, there are some other methods also when intangible asset is acquired through business combinations or through government grant. So then different approaches are there. But generally, when we are acquiring the intangible assets, it is recognized as cost. And if it is internally generated intangible assets, and in that case, if research and development phase is completed by the respective entity, then R&D expenditures, only the development expenditures are capitalized. Whatever research expenditures are incurred, that is expensed. And subsequently, it is the cost model or the revaluation model for the intangible assets also, which can be opted by the entities for the purpose of accounting at the subsequent date. And in investment property, it is the cost model. Basically, initial recognition is as cost, and subsequent measurement is also at cost model. And in fact, there is carve out from the IFRS where fair value model is also there. But Ind AS 40 allows only the disclosure of fair values. Accounting at fair value is not allowed under Ind AS 40 in the investment property. Then Ind AS 41 related to the agriculture. Here the biological assets which are produced or purchased by the entities are at initial recognition recognized at fair value less cost to sale. And if it is agriculture produce, so at the time of harvesting, it is recognized at fair value less cost to sale. So generally, agriculture produce is not recognized as cost, rather it is fair value less cost to sale. And again, at subsequent measurement, biological assets are recognized as fair value less cost to sale. And if there is any gain or loss, that is also recognized in the books of accounts in the profit and loss. And so far as leases are concerned, I would talk more on the operating leases, where from the lessee's point of view. So as and when any person is taking any asset on lease, he is to recognize the lease liability, which is nothing but present value of the all future payments, fixed as well as the variable payments. And then they have to also recognize the corresponding right of use assets with reference to that lease liability, which is determined at initial lease liability plus initial direct cost plus any prepaid lease payment minus lease incentive received. So this is the initial recognition accounting for from the point of view of lessee. And then in subsequent measurement, that lease liability which is recognized at present value is increased by the interest on that lease liability at implicit rate of interest, and then it is decreased by whatever lease payments are done. So the liability related to the lease is reduced by those lease payments. And then ROU asset is depreciated over the lease term, depreciated or amortized over the lease term or the useful life of that particular asset. So this is a brief subsequent measurement related details related to the leases. Regarding non-current asset held for sale, any assets or group of assets are classified as held for sale when that asset is available for immediate sale in the present condition. And then asset is available for immediate sale in the present condition. Sorry, it is mentioned twice. Then management is committed to plan a sale, and there is actively market for sale at a reasonable price. So in that case, if these conditions are satisfied, then all the non-current assets which are held for sale is either recognized is recognized as lower of the carrying value or the fair value less cost to sale. So many times, suppose a particular entity has its certain group of assets or maybe certain plant, and now it has decided that yes, it is required to be sold, and that too within 1 year. So there are other conditions also. Then such plant is required to be recognized at either carrying value or fair value less cost to sale, whichever is lower. And in subsequent measurement, suppose this held for sale asset continues to be there with the company, with the entity, then in subsequent measurement, the fair value less cost to sale is again determined. And if there is any impairment loss, that is also determined, and the difference of the FVCTS goes to the profit and loss account. It is basically charged or accounted for in the profit and loss. And if fair value less cost to sale increases, then reversal of the loss is done, but it is only to the extent of carrying amount of that original carrying amount of that particular asset. And during this period, no depreciation is charged once that particular asset is classified as held for sale. And for government grant, the amount which is receivable, so far as monetary grant is concerned, the amount which is receivable from the government is recognized at that receivable or received amount. And if it is non-monetary grant, then the fair value of that grant is recognized and not the nominal value. Basically, both options are there. So far as grant related to the income is concerned, in subsequent period, that income is either that grant is either accounted for as income or it is deducted from the related expenditures. If that grant can be related to any expenditure, then that expenditure can be reduced through that government grant income. And if it is a grant related to the assets, then there are two options available. One is it is to be reduced from the cost of that assets, or it can be treated as deferred income, and the same can be credited to the profit and loss account or the assets useful life, particularly in proportion of the depreciation, which is charged to the profit and loss. So these are the brief, you can say, many things I may have missed, but just to have an overview, I thought that I should discuss the at least recognition and subsequent measurement criteria related to various asset related Ind AS. Now coming to the various issues which are being faced while accounting. So first issue which I have considered here is related to the determination of the net realizable value of the inventories. So whether these costs should be considered while determining the net realizable value of the inventories. One is the cost of completion of the work in progress. The other is what should be the treatment of trade discounts expected to be allowed on sale, and then cash discounts expected to be allowed for the prompt payment. So if we see the work in progress, suppose there are certain items which are there in the work in progress, and the finished goods which are being produced out of that work in progress are sold at X amount. So how the value of net realizable value of that work in progress should be computed? Should there be any other process of determining the fair value of net realizable value of the work in progress, or it should be one should first determine the net realizable value of the finished goods, and then the cost of producing that work in progress or converting that work in progress to finished goods should be reduced from the net realizable value of that particular finished goods. So here the answer is that the from the estimated selling price, the necessary cost which is required to incurred by the company to complete the assets should be reduced from the estimated selling price of that finished goods. And that is how the NRV of the work in progress can be computed. So instead of assessing any separate NRV or separate selling price of that work in progress, one should consider that first they determine that what is the estimated selling price of the finished goods, and then the cost to be incurred for completion of that work in progress into finished goods should be reduced from that estimated selling price for the purpose of determination of net realizable value. The another issue is related to the trade discounts expected to be allowed on sale. So generally, the trade discount is given depending on the total volume of the inventory which is required to be sold, or for other factors, that what is actually market practices which are there. So for this reason, the trade discount should also be deducted from the estimated selling price if any discount is required to be given on those particular inventory which are there. Now coming to the cash discounts, it is basically not for the purpose of sale. So cash discount is generally for the purpose of immediate realization of the payment from the customers. So this cost cannot be said to be the cost for the purpose of realizing the assets. It is basically for the purpose of for the purpose of selling the assets, but it is for the purpose of realizing the assets timely, realizing the cash timely from the customer. So cash discount should not be deducted from the for the purpose of computing the net realizable value as per Ind AS 2. So this was the one of the issue related to the computation of net realizable value, which comes time and again as and when we prepare financial statements. Now coming to the another issue related to the uniform cost formula for similar inventories across the location. So many times issue comes whether the inventories which are lying at different locations. So different locations, whether the different formula can be used for the purpose of valuation of those inventories. Different formula means whether for inventories which are lying, say, at X location, a formula FIFO formula can be used, or at Y location, can it be weighted average cost? So this is the sometimes this type of issue comes. So answer here is that basically para 25 of Ind AS 2 requires that the inventories which have similar nature and use must be valued using the same cost formula, maybe at FIFO or the weighted average. So even if these inventories which are located at different geographical locations, if their nature and use remains the same, then same cost formula must be applied, and therefore using different cost formula for inventories which are lying at different locations is actually not permitted as per Ind AS 2. So one must take care of that if the inventories are of similar nature and use, then irrespective of the fact that at which locations these inventories are lying, one should apply the same cost formula for valuation of such inventories. So this was another issue which used to come. Then the issue related to the accounting of spares under Ind AS 2 or Ind AS 16. So basically this issue is not addressed in Ind AS 2, but Ind AS 16 covers this, and it says that spare parts are recognized as property, plant and equipment when they meet the definition of property, plant and equipment. So basically, many times the companies have spares with them, and they classify them as inventory only, whereas they do not assess that whether these inventories uh, meet the definition of PPE or not. And suppose if they meet the definition of PPE, then even if they are spare, they should be classified as property, plant and equipment. And for that, we need to see that what is the definition of PPE, and when such spares are classified as PPE. So it is said in the Ind AS 16 that if they are expected to be used in more than one period and are integral part to the fixed assets operations, then such assets qualify as PP. So suppose any spare which is usable for more than 1 year. So in that case, such spare, and of course, to deal with such things, one need to consider the materiality also, because sometimes, having small items, maybe 5,000 rupees or 10,000 rupees spare items, they are used for more than 1 year, but one need to take care of the materiality also. And accordingly, if some material spare items, which are also integral part of the fixed assets or plant and machinery rather, then such spare items and are can be used for more than one period, then such spare items should be classified as property, plant and equipment. And if this criteria is not met, then such spares should be classified as uh, uh, inventory only. And this is again, in many of the cases, I personally find that even such spares which are used for more than one period are classified as inventory only in many cases. So this actually need to be suitably addressed by the entities who are preparing the financial statements. And this is applicable not only on Ind AS, but now Ind AS 16 also. Because, sorry, AS 10 on property, plant and equipment also. Because now AS 10 is also on line with the Ind AS 16. So this was the third issue which I wanted to discuss on inventory. Now coming to the property, plant and equipment. Here also, particularly in case of mining industry, stripping activities, first solution has come. So should stripping cost during the production phase be recognized as expense or capitalized? So stripping cost is basically the cost related to the removal of overburden uh, during the production phase, particularly in the minings, and whether it should be recognized as expense or capitalized. This issue comes because through stripping, generally entities feels that there is no fixed assets as such which are being created through such property, plant and equipment. But this standard says that stripping cost should be capitalized when when such stripping cost, have the through such stripping cost, there is improved access to the future ore. So basically, generally in minings, the mine items, the production is being done after mining of say 10-year land or 10-year surface or 10-meter surface or 15-meter surface, and then then the products are mined. So the standard says that such removal of ore burden, whatever cost is incurred, should be recognized as separate stripping activity assets. And once that asset is recognized as separate stripping activity assets, it is amortized over the period of that over the period till that mining is done, mining of the produce or mining of say iron ore is done. So this is how stripping activity assets are required to be recognized and then required to be amortized according to the production which is being done through that mining. Then capitalization of employee benefits for project team involved in the setting up a new plant. So India 16 again deals with this. Here just one query is there that an entity G Limited is setting up a new plant. It sets up a project team comprising existing employees who will be responsible for setting up the new plant. The employees will work on a full-time basis and installation is expected to take 8 weeks. Whether the cost of project team, including all employee benefits, which will be paid otherwise, should be capitalized. So answer to this is that according to the para 17 of India 16, employee benefits arising directly from the construction or acquisition of an item of PPE are considered as directly attributable cost. So in this scenario, the cost of project team, including all employee benefits, is directly attributable to bringing the plant to condition necessary for its intended use. Therefore, these costs should be capitalized as part of the cost of the new plant, even though they would have been incurred otherwise, since direct attribution does not require the cost to be external. So here, basically, if the employee benefit expenses are related directly to the setting up of the plant, then it should be capitalized with the cost of the new plant. But many a times we find that there are certain employees, say employees who are actually, involved in the accounting of the project, or then there are, directors of the company, board of the directors. So many a times company wish that their salary or their employee benefits also need to be capitalized for the cost of the new plant. But in such cases, because such expenditures related to the finance team or accounting team or directors, these are not the expenditures directly attributable cost. These are not the expenditures which are directly attributable for construction of that plant. So these employee benefit expenses should not be capitalized in the cost of the new plant. Now coming to the borrowing cost related issues which generally comes. So here a query is there related to that Grapevine Limited is 1 minute. Grapevine Limited is in the business of producing wine in large quantities on a repetitive basis in its wine making facilities. It finances the production of wine through external loan. Should interest cost incurred by it to finance the production of wine be capitalized as per Ind AS 23? So generally, since wine takes a substantial period of time to be manufactured, a view may be there that any borrowing cost which is incurred for the purpose of production of such wine should be capitalized. But here an exemption is also there to the companies. So I would just tell about the provisions related to the Ind AS 23. As per Ind AS 23, the borrowing cost directly attributable to the acquisition, construction, or production of a qualifying asset shall be capitalized. However, para B 4B of the standard provides an exemption for inventories produced in large quantities on repetitive basis. So entities are not required to capitalize such borrowing cost due to the complexities and limited benefits of doing so. So here they give an option that if such quantities are produced in large numbers, large quantities are produced and that too on repetitive basis, then the entity may choose either of the one option. One is that it can capitalize the interest cost which is attributable to the wine production if the entity chooses to apply the Ind AS 23, or such expense may be charged to the profit and loss as interest costs also. So, in fact, Ind AS 23 gives an option in such cases, but whatever option is applied by the entities or by the companies, they should apply it consistently, and it should be properly disclosed in the notes to financial statements. It may be disclosed in the accounting policies also, as well as in the notes also, that what is the exact treatment for such inventories which are held by the companies. Now, another issue which generally comes is cessation of the borrowing cost capitalization for the partial completion of the projects. So here I will explain it through one example. BC Limited is in the process of getting an entertainment park constructed. For this purpose, it has taken loan from a bank. The said park consists of several rides and facilities, each of which can be used individually. 3/4 part of the park has been constructed and can be opened up for the public, while construction on the remaining part is continuing. Whether the capitalization of borrowing cost should continue for the whole park until the construction continues. So here in this case, if we see from the this case study, then it says that 3/4 park has been completed, constructed, and it can be opened up for the public also. That means the revenue related to this park, this 3/4 part of the park can also be generated by the company. So as per the Ind AS 23, even the partial completion, on the partial completion, the borrowing cost can be ceased to be capitalized. So here, since 3/4 part is complete, the borrowing cost to that extent should be charged to the profit and loss account, statement of profit and loss, and for the balance 1/4 part of the park, the borrowing cost incurred must be continued to be capitalized. So here are the here is the what does the Ind AS 23 says. As per para 24 of the Ind AS, when construction of qualifying asset is completed in parts and each part is independently capable of being used, the entity shall cease capitalizing borrowing cost for that part once it is ready for intended use. In the given case, the rights and facilities constructed are capable of independent operation, even though the entire park is not yet complete. Hence, the borrowing cost capitalization should cease for the completed 3/4 of the park, and capitalization should continue only for the remaining portion that is still under construction. So while accounting as well as the auditing, one must take care of that whether the completed part of the entire project is independent, can be independently used by the company for its revenue activities or not. Then it should be the partial capitalization of the borrowing cost should be there. Many times the companies argue that we have not taken the borrowing out of the our own capital. So whatever foregone benefit should be accounted for in the qualifying assets or not. So here they say, here one query related to this is there. Jabra Limited uses its own cash resources to finance the construction of a qualifying asset. It did not borrow any funds. Management of Jabra Limited is of the view that interest that could have been earned on the cash used for the qualifying assets represents the foregone benefit and could be capitalized as borrowing cost under Ind AS 23. So absolutely it is not permissible, because if we go to the definition of borrowing cost, then the definition is the borrowing cost are interest and other cost that entity incurs in connection with the borrowing of funds. And the para 3 also clarifies that this standard does not deal with the actual or imputed cost of the equity. So there cannot be, the standard itself expressly clarifies that no imputed cost of equity will be taken into consideration as per this standard. Then the use of the term incurs in this para 5 as stated here implies that only actual borrowing cost can be capitalized. Therefore, the notional or foregone interest income, that is the opportunity cost of using own funds, cannot be capitalized. So, Zebra Limited approach to capitalize the notional borrowing cost is not correct in this case. So, now coming to the issues related to the intangible assets. So, one important issue which comes these days, maybe that it can be issue of ongoing IPL also. So ABC Private Limited recruited a player. As per the terms of the contract, the player is prohibited from playing for any other entity and requires the entity to have an employment contract with the player that prevents the player from leaving the entity without mutual agreement. The price the entity paid to acquire the right is derived from the skills and fame of the said player. The entity uses and develops the player through participation in matches. Whether the cost incurred to obtain the right regarding the player can be recognized as an intangible asset as per Ind AS 38. So here, basically, the entity is binding the player that yes, you are being engaged by us, say for a period of 5 years, and you even cannot play for any other entity. And wherever we say you are actually required to play, and because of your fame, we may have some gains related to our marketability and all that. So whether the control over that player exists or not, that is required to be determined. So here is the solutions. So Ind AS 38 says that intangible assets should meet the following criteria. One is identifiability, then control, and then existence of the future economic benefits, and the reliable measurement of cost can also be done. So here identifiability is met because we have the right of that player, which is established through the contractual arrangement with the agreement with the player. Then there is a control also, because ABC Limited has controls, it can legally restrict the player from playing anywhere else and ensure future economic benefits from their services. And of course, future economic benefit are also there because of his participation in the matches. Benefits will be there to the entity because of the way he will play or because of the fame the player has. And then reliable measurement. The cost whichever is paid can be treated as the cost of such intangible assets, which is required to be recognized. So as per para 15, talent or skill alone usually do not qualify unless it is protected by the legal rights. So here the entity has the legal rights to protect itself, and they can direct the player that where to play and not to play for any other entity also. Then here, because of these reasons, the cost of acquiring the player's rights can be recognized as an intangible assets subject to careful assessment of the specific contractual terms and legal enforceability. So here also the intangible assets can be recognized. Now, this question generally comes nowadays is related to the cloud-based software access rights. So Z Limited enters into a contract with company M to access the application software, which is hosted on the M's cloud infrastructure for 5 years with fee based on the users. Can Z Limited recognize this as a software asset under Ind AS 38? So here again, we need to see identifiability is there. Yes, there is a software. Cost we are incurring, that is there. But do Z Limited has the control on that software or not? So that need to be accessed. If it has the control, then it can be recognized as intangible asset. If do not have the control, then it cannot be recognized as intangible assets. Then whatever expenditure are being paid are required to be accounted for as expense in the profit and loss. So here in Z Limited only has the right to access the software, but it do not have right to control it. The software is hosted and controlled by company M on the cloud infrastructure. Therefore, since the Z does not own or control the underlying software or even the hardware related to that software, so since it do not have the control over the software itself, the access fees which is being paid by the Z Limited cannot be capitalized. Rather, it should be charged to expense. Accounting for free radio license received under government scheme. So entity B receives a license from the government of India free of cost to operate a radio station in the remote areas, because government wants that in the remote area there should be accessibility of the radio to all the villagers, all that. So what is the accounting treatment as per the Ind AS? So here the company is not paying any fees for that particular radio station, but we can consider is as a non-monetary grant. So if it is considered as non-monetary grant, then what are the options available as per the Ind AS 20? That intangible assets may be acquired free of charge via government grants. So entity have the two options. One is recognized at fair value. So the license which has been received by the company can be recognized as fair value, and accordingly there is an income. So government grant which is recognized as income, so that should be considered as income over a period. And then another is recognized as nominal amount. So if there is no expenditure, no cost is incurred, then the nominal amount related to that non-monetary government grant can also be recognized. So but whatever is the whatever is the accounting which is being done by the companies should be consistently applied for all similar government grant received by the company. The another issue is related to the agriculture, Ind AS 41, and I have specifically taken the issue related to biological assets like poultry farms and all that. So P Limited is involved in raising a biological assets and recognize them at fair value less cost to sale as per Ind AS 41. The fair value is based on a market determined price at local markets. Due to some unforeseen circumstances, the price of the biological assets have been severely impacted, making them highly volatile. Management of P Limited believes that the prices in this market reflects abnormal conditions, hence are unreliable, and therefore wishes to adopt cost model approach for the current period. Can such biological assets initially recognized at fair value less cost to sale as per Ind AS 41 to be subsequently measured at cost less accumulated depreciation and impairment loss? So I would just come to the solution. As per para 30 of Ind AS 41, there is a presumption that fair value can be measured reliably for a biological asset this presentation can be rebutted only at the time of initial recognition and only if quoted market price are not available and alternative fair value measurement are clearly unreliable. So at initial recognition, we have already recognized such asset at fair value less cost to sale. So in the given case, since the biological assets was already recognized at fair value less cost to sale, now P Limited is not permitted to change the measurement basis to the cost. The standard requires continued measurement at fair value less cost to sale until disposal. However, the P Limited may provide additional disclosures that yes, these abnormal conditions are there is price volatility. So these facts can be mentioned in the financial statements. Otherwise, it is not permitted to change the measurement basis to the cost. Such cost measurement can be done only at the time of initial recognition if it is not possible for the entities to determine the fair value less cost to sale. I think this I am discontinuing. Now coming to the Indies related to leases. So we have another 10 minutes. So I will discuss leases, one or two issues, and then non-current assets held for sale. So here, the issue is that the entity X enters into a contract for a period of 10 years with a logistic company, entity Y, for the use of latest trucks. So as per the contract terms, entity Y has a large pool of similar trucks, and any one or more of which can be used to fulfill the requirement of the contract. Entity Y provides the trucks and drivers as part of the contract, whether the arrangement contains a lease of the trucks. So here, basically the entity entity Y has right of substitution of the assets. So substantially there is right of substitution of the asset. So can it be considered as lease or not? So we would just go through the relevant provision of the Ind AS 116. An asset is identified in a contract either explicitly or implicitly at the time it is made available for use by the customer. So here in this case, basically, if we see, then the trucks can be provided out of the pool available with the entity Y. So basically, as such, there is no identified assets which can be said to be there on the lease. So the trucks are not explicitly or implicitly identified in this contract. Entity Y has a large pool of the similar trucks and can choose any truck to fulfill the contract. So therefore, there is no identified assets which is given on the lease. So lease accounting will not be applicable here. The X will not be treated as lessee. Then assessment of lease for exclusive use of the auditorium. So here again, the issue is there that does an arrangement allowing a club to use a specific auditorium every Saturday and Sunday for a 5-year period to screen movies constitute a lease, even though the owner uses it on other days. So Monday to Friday, the owner can use for itself or can provide it to someone else. But every Saturday and Sunday, it is being given to some club for a 5-year period. For on Saturday and Saturday, the owner cannot use. So should it be treated as lease or not? So here the solution is there. The arrangement meets the definition of the lease under Ind AS 116 because according to the standard, a lease is a contract that conveys right to use an identified asset for the non-cancelable period in exchange for consideration. There is no requirement that the period of use has to be continuous. So if the right has been given for a period, maybe that even for 2 days in a week, but for these 2 days, exclusive right is there. So therefore, such contract will qualify as a lease, and even though the asset is used by the owner on the other days. So I think now, because already only 5 minutes are left, I would rather close this after discussing this particular query only, so that if the committee permits, then I can continue. So, assessment of right to direct use of an asset's air conditioning plant. So here the entity X enters into a 6-year contract with entity Y, which involves installing an air conditioning plant designed as per X specifications. So whatever X is, according to that specification, it has been designed. And entity X controls when, where, and how the plant operates, while entity provides operation and maintenance services. So does the entity X have the right to direct the use of the air conditioning plant? So here, basically, something has been predetermined that yes, this is how things will be done, and entity X has control that when, where, and how it will be done. So therefore, basically, identified asset is there, right to control that asset lies with the X, and entity Y has to basically only operate and maintain that only according to the predetermined criteria. So therefore, such arrangement between the X and Y should be treated as lease only. So one standard is remaining. I think Ind AS 105, 102 queries are there. If moderator permits me, I can continue.
So you can continue, please.
Okay, yes. So classification of assets as held for sale, impact of the incomplete renovation. So here, as I explained, that non-current assets held for sale, when it can be recognized. So entity Y owns a factory building. On March 25, the management decides to sell the building. However, before listing the building for sale, they plan to upgrade the electrical fitting and repair the facility, repaint the facility. These activities are expected to take 3 months. Can entity Y classify the factory building as a non-current asset held for sale as on March 31st? So here, basically answer is no, because what does the standard say is that the asset must be available for immediate sale in its present conditions. So since an entity Y is thinking that it is first required to upgrade the electrical fittings and repaint the facility, basically such asset is not available for immediate sale in its present conditions. So therefore, such assets should not be classified as non-current asset held for sale. Moment such electricity fittings are upgraded or repaint is done, and the entity has, still the intention to sell the building, then it will be classified as non-current assets held for sale. So what one need to see is that whether that asset is required, some modifications or not, or can be actually sold on the same, in the same conditions as it is available with the entity. Now, entity Z plans to sell its warehouse, which is currently leased to a tenant. The tenant is expected to vacate the property by April 15, and this timeline is usual and customary. Discussion with the potential buyers have already begun. Can the warehouse be classified as a non-current asset held for sale? as on March 31. So here the answer is yes, because even though property is occupied, the vacating time is standard and sale is highly probable, and such asset is available for immediate sale and accordingly can be classified as non-current assets held for sale. So friends, these were the few practical issues which comes day in, day out during the accounting as well as the auditing of the financial statements of the entities. And of course, there are so many practical issues which can be discussed, but in the given time, I thought that let me just, explore only the few of the issues which I can discuss with all the participants. If there are any questions related to the asset related Ind AS, I will be happy to address those questions. Thank you.
So the best part of this session was the case studies you created and provided their answers. I think that's why there are no queries came up at all.
नमस्कार सतीश जी।
नमस्कार भैया, आप कैसे हो?
बस एकदम ठीक है सर। आपको
मंत्री
पहले
सर।
तो बिलेटेड हैप्पी बर्थडे सर, कल मैंने मैसेज दिया था।
थैंक यू ब्रदर मंत्री
Now
जी, थैंक यू।
we have with us our esteemed chairman of the CP committee, CA Satish Gupta sir. He's a central council member of ICI. He currently chairs the CP committee and has led the SMP committee of SAFA and ICI's CSR committee. He has received awards like the Excellent Branch Award and Best Member of the Year for 2004. He is an active speaker and writer, having authored over 8 papers and delivered lectures on GST, income tax assessment and reassessment. Now I would welcome you, sir, to kindly share a few words with us.
Thank you,
Satish,
Nidhi.
sir,
Thanks a lot.
Thank you, sir.
My brother Bhupendra Mantri ji, very renowned faculty, very, I can say, great academician, and we give him trouble as of now, and whenever we look that, we give him trouble. And Nidhi Bang, management committee member of the Indore branch, Ajit ji, secretary CP committee, other team members of the CP committee and the tech support team. And I'm at the very outset, let me sorry that I could not join in the beginning because I was on travel. And travel, I reached to Arunachal Pradesh, Mantri ji, and yeah, and on the way I was not getting any signal, so I could not join. But when I reached to this place, I thought I should meet Bhupendra Bhai and others, and other members who are attending this webinar in a large number. So thank you everyone for attending. And Bhupendra Bhai, I know the way you teach us, and today also I noticed some of the practical problems you discussed in such a lucid manner that I think whoever attended this webinar must have got something, that you covered all the assets related Ind AS at one place. It is something really awesome. And I think for the attendees, it would have been the wonderful webinar. And I think the first part of the webinar would have been great with the presence of Kamal Garg ji. He was also a wonderful speaker, and he has written several books and continues giving the CP programs at his own also. Bhupendra Bhai also, Nidhi and others. Bhupendra Bhai also give the CP to his articles and other members also every Saturday. And we also get benefit out of that. So thank you very much. Vishnu Bhai, आए थे क्या Ajit ji?
Yes, sir. He was there at start, sir.
In the beginning, okay. So thank you, Vishnu Bhai, also.
Right.
So thank you each one of you again for this wonderful webinar. And friends, of my brothers and sisters who are attending this webinar, please don't forget that every Friday we do this we do the webinar on different topics 4 to 6 p.m. So don't forget to reserve your Friday 4 to 6 for this webinar of CP committee. And I also request you to give us suggestions also, that how we can make the webinars better, how can we make the CP programs better, how can we make the entire our profession or the institute better. We welcome your suggestion. So thank you very much. Thanks a lot. All the best. We have already crossed the 5 minutes apart from our time schedule. So thank you very much. Thanks a lot. See you again. Thank you. Thanks a lot. Thank you, Nidhi.
Thank you so much, Satish sir, for your kind words.
Thank you.
Thank you, sir. Thank you, everyone.
Now, I would like to give a heartfelt vote of thanks. On behalf of CP Committee of ICI, I would like to thank CA Bhupendra sir for taking time out of their busy schedule to grace us with their presence and share their valuable insights with us. And I would also like to thank all the participants who have joined us. Thank you so much. Thank you.
Thanks a lot. Thank you.